There is a man who has wanted to start investing for 7 years. He has read the books. He has watched the tutorials. He has opened and funded a brokerage account. He understands index funds, expense ratios, dividend reinvestment, and the historical average return of the S&P 500. He could explain compound interest to a classroom of students. He has never bought a single share. Every time he is about to click the button, something stops him. The market seems high. Maybe he should wait for a dip. A dip comes. Maybe it will go lower. The market recovers. Now it is definitely too high. He will wait. A correction comes. This time it feels different. The news is alarming. The analysts are divided. What if this is the beginning of a larger collapse? 7 years. No investments, no losses, and no gains. While inflation has quietly taken approximately 20% of his purchasing power, he is not lazy. He is not uninformed. He is experiencing the most expensive psychological pattern in personal finance. And here is the part that genuinely changes things. His brain is doing exactly what it evolved to do. 200,000 years ago, loss aversion was a survival advantage. If you were a hunter-gatherer and you found a bush with berries, eating them was a small gain. Calories, energy, a modest benefit. If you ate a poisonous berry, the loss was total. Death. The cost of a bad decision was so catastrophically higher than the benefit of a good decision that your brain developed an asymmetry. It weighted losses at roughly twice the intensity of gains. Avoid losses first, capture gains second, prioritize survival over optimization. This was not a bug, it was the most successful risk management strategy in the history of life on this planet. Every one of your ancestors followed this rule. The ones who did not, the ones who treated gains and losses symmetrically, who took risks with the same enthusiasm they brought to safety, did not become your ancestors. They died. Their genes left the pool. The asymmetry that remains in your brain is the filtered, refined product of 200,000 years of natural selection. That asymmetry kept your ancestors alive, and it is the reason you are sitting in cash while the market compounds without you. Now here is where it gets genuinely interesting. When you look at a stock chart, your brain does not see an investment opportunity. It sees a predator, a volatile green and red line that could take your resources away. Your amygdala, the threat detection center, activates. Cortisol and adrenaline enter your bloodstream. Your body is preparing for fight or flight, but you cannot fight the stock market and you cannot run from it. There is no predator to confront. There is no physical threat to escape. So your brain selects the third option, freeze. Psychologists call this the freeze response. When neither fight nor flight is viable, the nervous system defaults to immobility. Do nothing, stay still, wait for the threat to pass. In the wild, this sometimes works. A predator loses interest. The danger moves on. Immobility ends. Life resumes. In financial markets, this does not work, because the threat is not a predator that will eventually leave. The threat is your own perception of market volatility, and the market never stops being volatile. The S&P 500 has experienced an average intra-year decline of approximately 14% every year for the past several decades. Despite those declines, the index has ended the year positive in the vast majority of cases. The volatility you fear is not an anomaly. It is the normal operating condition of every financial market in history. So the freeze response never ends. You remain paralyzed indefinitely. You tell yourself you are being patient. You tell yourself you are waiting for the right moment. You are not waiting for anything. Your nervous system has locked you in place, and your rational brain is generating justifications to explain why standing still is actually a strategy. Consider the specific mechanics of what happens in your brain during this freeze. The amygdala, having detected a threat, sends signals to the hypothalamus, which activates your sympathetic nervous system. Your body floods with stress hormones. Your muscles tense. Your breathing becomes shallow. Your attention narrows to the perceived threat. This is useful if the threat is a predator that might strike at any moment. It is catastrophically counterproductive when the threat is a line on a screen that will, statistically, recover on its own. But your brain does not know that. Your brain does not have a module for distinguishing between a tiger and a ticker. Both are interpreted as potential loss. And potential loss triggers the same cascade regardless of its source. That is the irony. The instinct that kept your ancestors alive is the one keeping you broke. But here is where it gets genuinely uncomfortable. There is a second force compounding the first: inflation. While you sit in cash, waiting for the fear to pass, your money is losing value. Not theoretically, mathematically. At an average inflation rate of 3%, money sitting in a savings account loses half its purchasing power every 24 years. That is not a prediction. That is arithmetic. And the arithmetic does not care about your comfort level. Imagine you have $50,000 sitting in a savings account earning minimal interest. Inflation runs at 3% annually. After 1 year, your $50,000 has the purchasing power of approximately $48,500. You still see $50,000 on your statement. The number has not changed, but what that number can buy has shrunk. After 5 years, your $50,000 has the purchasing power of approximately $43,000. After 10 years, roughly $37,000. After 20 years, roughly $27,000. You have lost nearly half your wealth. There was no market crash. There was no red number. There was no moment of crisis. There was no cortisol spike. The loss was silent, continuous, and invisible. This is what I call the paralysis tax. It is the most insidious form of loss because it is invisible. When the market drops 20%, you see the number. It hurts. You react. You feel the pain immediately and intensely. When inflation erodes 20% of your purchasing power over a decade, you do not see it. Prices rise slowly. Your salary rises slightly less than inflation, on average. The gap widens in silence. There is no red number on a screen. There is no cortisol spike. There is no moment of crisis. Just a gradual, invisible transfer of wealth from your savings account to everyone who invested. And here is the part that genuinely changes things. The people who profit from your paralysis are not Wall Street insiders. They are not hedge fund managers. They are ordinary people who set up automatic monthly contributions to index funds and then stopped paying attention. They are the people whose money was in the market while yours was under the mattress. Every dollar you held in cash, declining in value, was matched by a dollar in the market, growing in value. The wealth did not vanish. It transferred, from the frozen to the invested, from the cautious to the systematic. This is the cruel mathematical reality of inflation. It is not neutral. It does not affect everyone equally. It punishes the cautious and rewards the bold. It takes from those who hold cash and gives to those who hold assets. If you are sitting in cash because you are afraid of market volatility, you are not avoiding risk. You are trading one risk, visible, dramatic, temporary market declines, for another risk, invisible, steady, permanent purchasing power erosion. And the second risk is far more dangerous, because it never triggers your fear response. It never makes you want to act. It just quietly compounds. And here is the part that genuinely changes things. The people who build wealth in the stock market are not the ones who feel no fear. They feel the same fear you do, the same amygdala, the same cortisol, the same ancient wiring. The difference is not emotional. The difference is structural. Wealthy investors have a system that operates independently of their emotional state. They invest automatically. They invest on a schedule. They invest amounts that are predetermined. They do not make investment decisions in the moment. They make them in advance when their rational brain is in control, and then they let the system execute regardless of what the market is doing. This is called dollar cost averaging. You invest a fixed amount at regular intervals. When the market is high, you buy fewer shares. When the market is low, you buy more shares. Over time, your average cost per share is lower than the average price of the market during that period. You do not need to time anything. You do not need to feel brave. You just need to show up. The system does what your nervous system will not allow you to do. It acts during fear. It acts during uncertainty. It acts during every moment when your brain is screaming at you to wait. Consider what happens over a 30-year period. You invest $500 every month into a low-cost index fund. You do this regardless of market conditions. When the market is at all-time highs, your $500 buys fewer shares. When the market crashes, when every headline is predicting the end of the financial system, your $500 buys more shares than it ever has. You are, without feeling brave, buying low. Not because you timed the market, because you showed up when the market was low and the system did what it always does. Over decades, those actions compound. not linearly, exponentially. Because each investment you make during a period of fear is a share you purchased at a discount, and every share purchased at a discount is a larger piece of the recovery. And every larger piece of the recovery generates dividends that are reinvested into more shares. And those additional shares generate their own dividends. And those dividends purchase additional shares. The system builds wealth while you sleep, while you are afraid, while you are frozen. The system does not freeze. That is the difference. The system is not emotional. The system is mechanical. And mechanical systems beat emotional ones over any meaningful time horizon. But here is the deeper insight. The system does something even more important than generating returns. It eliminates the decision. And the decision is where all the damage occurs. Every time you have to decide whether to invest, you open the door to fear. Every decision point is an opportunity for your amygdala to intervene. Every decision point is a moment where your prefrontal cortex has to override 200,000 years of evolutionary programming. Sometimes it succeeds, often it does not. The more decision points you have, the more failures you will accumulate. And in investing, a single failure, a single moment where fear wins, can cost you more than years of disciplined contributions. The system eliminates decision points entirely. You do not decide whether to invest this month. The system invests. You do not decide whether the market is at a good entry point. The system does not care. You do not decide whether the news is alarming enough to justify waiting. The news is irrelevant to the system. The system acts every month, without consultation, without hesitation, without the possibility of fear intervening. Now here is the most critical insight in this entire video. Most people spend enormous energy trying to override their fear. They try to feel less. They try to think more positively. They try to force themselves to be brave. They read motivational books. They listen to podcasts about overcoming fear. They repeat affirmations. They push through. And every single time they are fighting a battle against their own neurology, a battle they will eventually lose because their neurology has a 200,000-year head start. The answer is not to override the fear. The answer is to build a structure that does not require you to feel anything. A structure that invests automatically, on a schedule, in amounts you have decided in advance, regardless of market conditions. A structure that acts for you when your biology will not let you act for yourself. You do not need to become someone who is not afraid. You need to become someone who has removed the need for courage from the equation entirely. The bravest investor is not the one who feels no fear. The bravest investor is the one who has built a system that makes fear irrelevant. You were never the problem. Your wiring was. And your wiring can be routed around. Have you ever found yourself unable to make an investment you knew you should make? I genuinely want to know what happened. Tell me in the comments below. And if this changed how you think about why you are hardwired to lose money in the stock market, subscribe. Because this is exactly the kind of conversation we have here every single week.